You have something, a guiding, something to guide me.
Mm-hmm.
Your focus is that tax thing, the tax procedure?
You know what? I can take your. I need your seasoning on all of it.
Okay,
I am. I'm studied, and
okay,
really in all FI, I'm pretty studied.
okay,
But I need your
oh,
additional seasoning and connecting the dots and everything.
okay,
And the two last configuration points on this deck is tax codes and tax procedures.
okay. Yes, sir, Bobby.
With everything you have to offer in way of information, I'm
Mhm.
all heart and ears.
Yeah. We're
We can just space through. Would you like to drive? All you gotta do is
yeah.
hit a spacer.
Like this is the controlling area, right?
Mm-hmm. Yeah, and I'm gonna say on the left hand side as well, which
Mhm.
configuration point as well.
You will usually set this to number 2, which just means that multiple company codes can be assigned to it. It's not a one-to-one relationship. It's multiple companies getting us be assigned to that controlling area. It's like an umbrella, the controlling area has all the companies rolling up into it. And it's okay. So you'll see here one controlling area, and then you can put all the companies under it. But you got to set it up here first to allow it to do that. And then you'll see, because right here is only saying one, but you can have all your companies under here assigned to this one controlling area. It's a one-to-many relationship. Even though you see a one-to-one, that's not typical.
Mm-hmm.
It is a one-to-many. Operating concern sits even above the controlling area. So it's the company code, the controlling area, and then the operating concern. It's at the highest level,
Mm-hmm.
the operating concern.
It's a good question.
Mm-hmm.
With assets, with fixed assets,
Mm-hmm.
where does the chart of depreciation area in asset class sit in relation to? Do they sit above the operating concern on the same level?
No, yeah, no, I don't think it's at the same level as the operating concern. I think it's
I read that it was they were independent of the controlled area and company code.
yeah, I think it sits kind of parallel to a company, a controlling area,
Mhm.
because you assign many company codes to a depreciation area. You would typically, um, but it usually, a controlling area is usually have multiple currency, multiple countries can be assigned to a controlling area. But a depreciation area, you would typically do it by country.
Mm,
Mhm. But a controlling area, you would not, you can have it by country, but it's not typically assigned that way. It's just all the companies roll into this controlling area, generally speaking, so that you can report all the companies under one controlling area. And of course, the operating concern sits above that controlling area. But a depreciation area is typically like parallel to probably the controlling area, but it still has its own kind of hierarchy.
mhm,
But it's usually like companies within a country, you know,
mhm,
because the depreciation rules are really country specific.
mhm.
You know, Canada has its own asset rules. U.S. has its own, some that kind of thing.
Okay.
Now the controlling now so but you see these controlling areas and operating concerns, even though you have the FI area, but then that is kind of company these operating concerns and controlling area usually are P&L focused. They're you how you get to them when you record to them is P&L accounts. So you have to create so when you create your GLs, everything on the P&L that sits in the P&L, like the revenue on down, revenue cost of goods sold on down, has when you look at it from an FI perspective, it's a GL. When you look at it from a controlling area operating cost, it's a cost element. And so how you make the connection is that you assign the GL to the cost element, and then that bridges the gap between the FI area and the controlling area. So it will not pass into the controlling area unless there is a cost element. So you will see, well, the GL and the cost element looks the same, 5 series, and you have the cost element over here is a 500, the same account. If you don't connect them, the GL with the cost element, it will never pass over
Mhm.
to the controlling area. That's the connection. So when you say cost element, you are in the controlling area. You're in the controlling area. When you're in the GL, you're in the FI area speak.
Mhm.
And if the balance sheet, for instance, anything on the balance sheet, typically, most of the time, will not have a cost element. When you assign that GL, it's gonna say what's the cost element for it to be a P&L. They want you to connect the P&L to this operating concern, to the controlling area, so it can report on it. If you got an asset or cash account, it's on the balance sheet, it's not going to ask you for cost element. Therefore, it's not going to be visible in the controlling area. That
Yes.
way. Okay. So you'll see that. So now I'm okay. So here, um, good, good.
Yes, I can probably say it back to you.
Yeah. Go ahead.
I shouldn't have said that.
Yeah.
Okay, so
FI and
balance
FI and CO.
P, the P&L.
Mm-hmm.
Okay, this is more CO based cost element.
Mm-hmm.
Okay, and the balance sheet is more FI based.
Mm-hmm.
Um, if you want,
Now the whole FI is the whole balance sheet and P&L,
yeah,
right?
put together.
Yep,
Okay, assets, liabilities, equity, revenue, and expenses. It's
Mm-hmm.
all in FI.
Mm-hmm.
Now, if we want that to go into CO, you have to link the general ledger to the cost element.
Yes,
Then
yes.
it'll pass on.
Yeah, it'll pass over. Absolutely. So then this ledger. A ledger in SAP is really how you enter transactions to it, the ledger, the ledger. So now you have to come and say, okay, well, a ledger is how you get transactions onto a company is a ledger, and a report is how you get data off of it, right? So it's gonna say, okay, here, so here is how you put transactions up. We typically now you can have multiple ledgers, so you can see you can have a tie to a company, so you can actually have parallel ledgers when a company come in. You can typically, some companies don't use them, but you can have a parallel ledger running side by side, like a country specific ledger, a local ledger, or your main ledger.
Leading ledger.
Yeah, yeah, your leading ledger. That would be your leading ledger, and you would have that. You got to have that one, right? That's how data is getting into your company. It's on the ledger, on the accounts. You get it through on that ledger. So you have to have a ledger. You can see when we talked about special purpose ledgers, those are the same thing. Is here are the rules to get something onto the transaction of the company code. You need the ledger to put it on there to get the transactions on there.
Question:
Yeah.
is a special purpose ledger in the what is that called? A special geo indicator? Are they the same thing?
No.
No.
Mm-mm.
Okay. It sounds
So
very similar.
a special geo indicator and a special geo indicator, and then a special purpose ledger. So here you can have a leading ledger and a special purpose ledger. So when a transaction hit it, you can say, okay, all 100% transactions going to hit your leading ledger.
Mhm.
And then you have a special purpose ledger that says, I only want um,
Oh,
cost centers. I only want a specific portion of this leading ledger to hit the special purpose ledger. Only specifically cost centers. But over here, it's got cost centers, IOs, all kinds of production and everything like this hitting on your main ledger. Everything has to hit, right? Then this special purpose, you can narrow it down so that only specific transactions enter this ledger. Um, when you use a special purpose indicator on a ledger, usually it's reconciliation accounts. Yeah. And so what you
yes.
tell, so when you create a reconciliation account and you have, if you assign an account to it, you say, okay, here is the reconciliation account and here's the sub ledgers. Customers are a sub ledger that points to a ledger. Customers, all the customers under here points to the AR ledger, but they're sub ledgers, all the customers, and they reconcile the sub ledger to the ledger. AR ledger, and so it's reconciled. Now, all these customers have the ledger assigned to them.
Mhm.
Every customer have the AR assigned to them. And if you use a special purpose ledger, you tell the special purpose indicator, not the special purpose indicator, don't go to this guy this time, go to another guy. Yeah.
Mhm.
So it says, okay,
Yes.
I want you to point to prepaids, or I want you to pull liability. Don't go to so this time, go to another account.
I'm
Yeah,
tracking.
yeah.
I'm
So
tracking.
that's really just okay.
Yeah.
Ignore what's on you on the master record of you customer, and but go to this. So when you assign that indicator like an A or R or P, or you have to tell it, here's the old number, here's the new number I want you to, and it's assigned to that letter. So that letter says, okay, you are the indicator A. Now don't use the normal one. Go to the second one, the reckons the alternative account.
Yes.
The alternative account. So
Alternative reconciliation account.
yes, yep,
Yeah.
yep. Because it normally sits in as a reconciliation account, and then all these sub ledgers, which is the materials roll up into the inventory, customers roll up into the AR, vendors we roll up into the AP, all the different kind of sub ledger things that make it. But so everything that point every time you hit this customer, it reports to the ledger. Boom, 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 right? So it keeps it in balance.
Yes.
So that's now a ledger and a special purpose ledger is different than a local ledger. And these are local. So I can have a Mexico ledger, and but I can have another ledger so that I can report because they might report their inventory first. Some companies report, some countries don't arrange their balance sheet the same way we arrange ours. Right? So they may go from inventory to cash, less liquid. And we report based on liquidity, the things that can turn to cash the quickest. Cash is cash. Next thing is investments, and the next thing is AR, and the next thing is prepayments, and the next thing is inventory. Next thing is fixed asset. Those go to long term. It's organized in terms of liquidity. How quickly can it turn to cash? And some countries may not have that same arrangement. So you can have and they have certain other requirements, that they're requiring. And so those are country specific, and you can have those are local ledgers that it's trying to be operating in that country. Uh, so as you can see here, um, this is just multiple currencies to a company. So when SAP is multi-currency, so as you can see in this local ledger, you can have a local accounting. This is how that is going to get to that ledger Z1. You're going to have accounting principles local. It's going to have this fiscal year variant. These are the posting periods. And it can have multiple currencies, 3 currencies that track it on the same. Anytime you enter this guide, you have to enter it through this accounting principle, this ledger, and it's going to track, uh, 3 currencies for you: a company code currency, a local currency, and a group currency. And that's getting to that ledger. And then it's just a placeholder on saying here's the principles entering into that ledger. These doc types, these are very useful. Because you can't enter a ledger without a doc type. Each general ledger has to have a doc type, and it's like a flag. It's a way in, right, to the ledger, right? But you got multiple streams of going through the ledger, so you can say, here's assets coming through. You're going to all have assets in this AA. You're going to have all of these, customer postings going to come through these Ds. All these Ks are going to come through these vendors. And so so when you look at the entries on the ledger, you can say, okay, summarize it by the doc type. Well, if you can summarize them by the doc type, say you got 100 different transactions, then if you group them by the doc type, you will know how they came into the ledger. They came into the ledger this way, that way, because when you assign how they come in, you give it a doc type, right? So it's like a traffic cop kind of thing, and when you look at a ledger, you say, oh, well, it's only one doc type and one doc type. You know how it came in. Okay, it came in through fixed asset. It came in through CO. It came in through AR. It came in through OTC. It came into P2P or whatever. Each one of them have its own unique button. And of course, you give it its own number range. So here you can say this doc type is allowed for these kinds of transactions. If you don't check the account type that's allowed for the doc type, then you can't use it. So if I deselect in the account type allow on the doc type, then if I deselect assets, customers, materials, then only vendors can hit this guy. You would only, so both sides of the entry, both sides, the debit and the credit, will both have to be vendors. But unless you have to have a ledger and a vendor if you want one side of the entry to be a vendor and the other side to be a P&L, like a ledger. So you are this in essence, you're telling it what you have to be to come in using this document type, and that's the group type. You can see a lot of them says, okay, well, I'm going to allow this, and this to come through, right?
Mhm.
Um, if you see these secondary cost elements, these are only cost elements that are used in controlling. They are not in there. They're typically, uh, since they've consolidated, but they're called secondary elements. You usually enter those transactions through controlling. So uh, you'll see on this list transactions like GLs, they all can originate from FI. They hit controlling, right? Come through FI, hit controlling. Come through FI, hit controlling, right? you know, in production, you hit those ledgers and it comes through FI like a module, a sales module, hitting the invoice. It comes through there and hits, but it's going to hit the FI and it's going to hit controlling. It's going to hit the FI and hit controlling. But there are some areas like statistical elements they're secondary elements, and they are statistical elements. They hit you manage them through controlling, and then they kind of hit FI that direction. They kind of come from controlling to um, FI. Some examples of that kind of stuff is if you're allocating costs from one department to another, you just say phones, you want to assess it to other departments. It says, okay, I got all these phones and you got all these indicators and indicators you want to charge it from one department and give it to another department. That's only internal allocations, and you would do that kind of stuff on secondary elements. It's not a financial thing. It's kind of statistical on how you want to manage each department,
Mhm.
like phone, phones or computers or everybody in their computer. You have to buy a computer for everybody in the government. But if I want to allocate, charges to every department, something like that.
Mhm.
But you can see you can control. This guy's controlling, and you assign a number range to it. So if you look at a number, this doc type is you said, okay, you're not allowing this guy to come through here, and I'm giving you a number range. So if I see a number range, I see 18 and stuff, I know immediately where it's coming because I know it's this kind of doctor. All 19s are vendor invoices, all of them, and you give it a number range, and it has to stay. It's going to conform to these rules. So if you see a 45, you're going to see the number is 51, 50. You know the type of transaction it is. You know the doc type that it came from, and you know the module that it came from. If it came from fixed asset, it came from MM, it came from an invoice, it came from sales. Because each one is going to, now you can repeat, you can put a couple modules can go into one doc type, you know what I mean? So several modules can be hit. But if you were to really isolate it, you can have them use one, and you'll know exactly how it's coming into your ledger using these doc types,
Mhm.
right?
Mhm.
So you see, okay, 16 series, okay, and this is something that you would control. So now so if you were to keep all of these and you organize them in a certain way, you can assign them to these type of doc types, and you're managing because it's got you see the long series is to get the different all kinds of transactions, but you can look at each one of them and say, hey, I know where this, I know, I can see the doc, I can see the number range, I know the document type, and if I know the document type, I know how it came into my ledger.
Mhm.
Right. uh that's that same uh ledger doc type scenario. That's the same asset doc type number range. That's for that special purpose ledger. And currency. Currency is, kind of a if you don't set the currency, the multiple currencies up when you originally start, and it's very hard to change the currency subsequently. Especially with open items, like so if you don't give three currencies when you first set the company up, it becomes a little bit more difficult to assign the currencies to them later, like a group currency or U.S. currency or local currency and a company code currency. Because when the AR hit the books, it hits the account. It's only in one currency. Then you try to switch and say, hey, I don't have the three, unless you got to clear out all your AR, you got to clear out all your receivables, got to clear out, got to reset everything before you can turn it on because the transaction had only one currency. So when you want to switch the currency, oh, it's going to fail. That transaction is going to fail because you asked me to conform to three currencies and I only have one when I originally went into the transaction as an open item. And now you want me to pay. Now you want to pay me. You want to say if I owe a vendor a payable, and then now I try to pay it. It says you switched to multiple currencies. Hey, I don't have some multiple currencies because when I went into the transaction, I only had one. And so then it creates that conundrum. You got to clear out all of those transactions, then set the currency, and then put them all back, and it'll put them all back into multiple. So it throws the whole thing off if you don't set it up initially. You have to go. You I mean nothing doesn't say you can't do it. It's just that you have to clear out everything, then set it, and then put them all back. So that it'll have the currencies when you try to clear them out.
Mm.
Make sense?
Yes, absolutely.
Exchange rates is you can have in accounting rules is that you can have exchange rates in different points of view and exchanges at times, currencies. So you can have currency transaction that hit every real time. At the month end, you can say, okay, here is the new, here's all my currencies is in Canadian dollars. I want to translate them into US dollars. And so that you can get a revaluation of your balance sheet in uh, foreign currency, in US dollars when it's all sitting. So that's a month end activity. And then you can have a currency that's hitting real time currency transactions. And so all of these can be done at different kinds of ways. You do a consolidation. When you do consolidate, you can have your assets use a different currency rate and different, so that you can get the best currency that it's a historical currency when it happens. So you can best represent the right. If you try to roll up into a group currency, you can use all these different currencies in all these different situations to translate from one currency to another at different times of the month or at the end of the month. Typically, it's at the end of the month when as an example, you've been selling, you are a US based company, you got 80% of your sales are US dollars, another 20% is Canadian dollars. So at the end of the month, you're sitting there with, so you've been recording them doing the exchange rates for every given day. Every day, all day, the currency is changing. Every day, the exchange rate changes all the time, especially through political
Hmm.
turmoil with it. So it's different political issues and all kind of company issues and currency is changing all the time. So every transaction is getting a different currency, boom, 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 every time it's coming through. If you're updating this translation all the time, U.S. Canada. So you got 20% of your receivables in Canadian dollars and 80% of it is in U.S. dollars. So at the month end, you say, okay, I want a spot rate. I want to find at the end of the month, I'm going to translate everything, all of my Canadian 20% AR into what it would represent in US dollar at this specific spot rate at the end of the month. Then you can get, here's what it would look like for converting my 20% of Canadian dollars AR into US dollars. You know, now I got a representation of the whole AR in US dollars at a particular spot rate of translating at 20%.
Mm.
Makes sense?
That's right.
Yeah. So, and you can see how this can be updated monthly, daily. You can see it's daily. Every time you put an entry in here, it will be good until the next entry.
Hmm.
So it stays like this guy's 1798. That's good until now. If you enter one in 2021, it'll be good until infinity. So it's the latest one. And so if you enter a new one, it's going to be everything behind it is using the old rate, and everything up front of it is going to use the new rate. Um, a direct quote and indirect quote is basically, so you see direct quotation and indirect quotation. It's just the reciprocal. It's just the reciprocal. Is it how you do the conversion? Are you using one currency as the main? You divide it or you multiply it. That's really, so you will see that this guy is using the direct quotation. So it's going to convert that to that using a direct. If you use the indirect, it's going to divide it. That's basically when it runs. So if you run this guy, this currency to this currency, it's going to use a division. And this one here is going to use a multiplication, and it's that's kind of that kind of thing. And it's only using this five decimal places to that. That's as far as you can go on it, right?
Okay.
But some markets have it, 6 digits or whatever. But this is what they provide.
Yep,
Okay.
yep, right there.
Tax procedures. Uh, yes. So SAP with tax procedures. SAP has the ability to track taxes on sales and purchase and expenses. Um, companies usually would buy a tax product like a Vertex, uh, or they'll use the SAP product. The advantage of a Vertex or a taxware is another kind of tax software, but it's for sales and use taxes. You understand the difference? Sales taxes versus use taxes, but it's for sales and use taxes. You put them together, you have to report what's your sales and use taxes. The sales taxes occur on the AR side, and the use taxes occur on the use tax on the payable side. So sales and use. Use is for accounts payable, sales is for AR. Sales taxes, use taxes on the AP. Each jurisdiction in each county and state, just like Oswego may have a tax. If you sell within the Oswego County, you have to pay the Illinois, the county, the municipality, and even at a local area. So it could have a tax code of 5 levels deep. You know, you got a 10% at the state, 5% at the county, 3% at the city, another 4 at the municipality, just hypothetically, right? And when that jurisdiction hits, and you use that particular jurisdiction that you sold into this region, you have to pay taxes to that local region, right? For that particular sales tax. And so companies have to buy products if they're selling in a lot of regions in the country, because you actually almost have to have people who keeping track of all of the local, every city, county, and municipality jurisdictions that they have and what's their rates. So they buy software products who are keeping track of all those rates across the country. If you're only dealing with selling in 3 counties in Illinois, then you can use, because you can keep track of the rates in that particular county and jurisdiction. So you have to maintain. Now, you can also get a service to update these rates, like, because there's a place to put the rates inside of the tax procedures in SAP if you want to use SAP tax procedures, tax sales and use tax procedures. So that's where you're saying, I'm going to use SAP tax procedures, and I'm going to put those rates in these tables so that when I have a sale that record into that, then it's going to properly tax it. So, for example, and you have to do it not only by products, but by services. Illinois doesn't tax services. Like if you auto repair guy, you bought some parts, parts are taxable, but the services is not taxable.
Mhm.
In New Jersey, it's different.
Mhm.
The services are taxable and the parts are taxable. So it's very unique and regionalized to different counties, cities, and so it's very the tax rules in every county, city, municipality is different.
Mhm.
And you have and it's even the products and services are different.
Mhm.
And it's all these incentives and non-incentives and all that kind of thing. So, but if you're able to track it in SAP, then you would put the rate that you're going to charge uh, for that in SAP and let it calculate. So now what that does is says, okay, so you're sitting here with an access sequence, a condition record, and a procedure, right? And so when the comment, so typically, so I'm gonna do it on the sales side and then on the use side.
Mhm.
So typically, you would charge taxes where in the jurisdiction that the product wound up in. So you can be a sold to party that is shipped to in a different, you ship to it and you sold something in Cook County and you shipped it to Will County, right?
Mhm.
The tax rates is where you shipped it to.
Mhm.
So it's not where you sold it. You sold it to the corporate office in Cook County and they asked you to ship it to Will County. The tax rates on the typically is based on where the product wound up at. Now, the if the taxes are usually calculated on end customer sales. When did it get to the end customer? If you're selling it to someone who is going to sell it to the end customer, then they typically don't pay taxes.
Mhm.
It's only to the one who sells it to the end customer. If I'm selling it to the end customer, then I got to collect the taxes. But if I'm selling it to someone who is a distributor who's going to sell it, then I don't charge them. The distributor is the one who has to charge the taxes because they're selling it to the customer.
Mhm.
They're selling it to the end customer. You good?
I don't got my phone on me.
Hmm? Yeah.
Don't
Close your head, your phone. Right there. In that little slot.
Oh.
Down there.
I'm sorry. Just checking the time. 12 minutes.
Oh,
I think we fine.
okay. So now,
So,
as you can see here, is that you can see you don't charge sales tax on all transactions because it's only to the final customer who consumes it,
yes.
right? So it's a retail, that. So if I sell it to a retailer, I don't charge the retailer. The retailer charges the taxes.
Mhm.
Bec- And if and so on the same goes true on the use tax. If you're buying product to manufacture another product, then you typically don't pay taxes on the product because you're using it in the manufacturing process. Then when you get a finished good, you pay taxes on the finished good. The taxes on the you're selling of the finished goods,
Mhm.
right? But you don't usually pay taxes on things you're using in the manufacturing of something else. So the use tax means that you are consuming it. You are the consumer.
Mhm.
You can just the same thing on this house. You're selling it to a retailer that's the consumer, right?
I don't know what that was.
Mm-hmm. I will continue.
Nope, I'm good to go.
So the consumer. So an example of consumption-based things would be office supplies,
Mhm.
paper, um, things like that. I'm using as a company that I'm consuming. But if I'm buying raw materials or packaging materials that I'm putting in packaging, I don't pay, you typically pay taxes on those things that I'm used in the manufacturing process. But when it comes out of the back and it comes out the end and you sell it to then it gets taxed. So on the use side, the same. So when um, a vendor charges for a product, he has to charge taxes on only on certain items, right? That comes into it. That if he's selling to me and I'm using it in the manufacturing process, they typically don't have taxes. But if it's selling something to me that I'm consuming in just consumption as in my process, computers and I'm not taking computers in manufacturing making servers.
Mhm.
I'm using computers in the consumption of the company.
Mhm.
So I would typically have taxes on those things. So the consumption. So what that simply saying is that so when you have certain conditions that you know a customer, a ship to, a party, you have to set those access sequences and condition records so they're saying uh, when these conditions occur, put a tax code on there, and this tax code says taxable or not taxable. SAP comes with tax codes that says um, an I-1, an I-0, or a O-1 or O-0. Those are four tax codes that and they have others, but those are the four main ones. I-1 is a taxable transaction, a taxable tax code. So it says, okay, this transaction is an I-1. And then this is a I-0, non-taxable. And then on the AR side, you got a 0, 0. It says it's tax exempt, or 0, 1 is taxable.
Mhm.
So when you create a material master
Mhm.
and into the system and you create a customer in a material master, you put those tax codes on it. So this is a taxable event. This is non-taxable. So if you create a purchase order and this product that you're buying is used in the manufacturer, you would put an I-0 in the master record saying it's a non-taxable. So when you create the PO, it's gonna say, I'm gonna use in the pricing procedure of the of the of the pricing procedure of the purchase order. That pricing procedure is going to trigger these tax conditions in there. It says,
Mhm.
oh, here's a rate that you have in the system, and now bring this rate into the pricing procedure because I have put I-1 on the master record in or the vendor. And now it knows that, this is a taxable event. It brings it into the pricing procedure, and it brings in the pricing procedure the conditions that are taxable from these setup over here, and the setup in the procedure. Let me reiterate it. It's master data driven kind of thing. So if you set your vendors and materials and vendors and you put on them, there's a bucket in there to say that these are taxable or non-taxable kinds of transactions. And if it fit certain criteria that this material is taxable or non-taxable. So it brings the tax code of an I-1 into the pricing procedure of the purchase order. Right?
Mm.
And then it says, and then in this purchase order, it says, when this occur, bring in the tax procedures, bring the tax conditions in the pricing procedure, and bring in this rate when you set it up. So, okay, you told me that this transaction, this is typically a taxable material, right? And then it brings it in, and it brings it, and it goes and fetch the rate out of here. Stuff. You said it's an I-1, so now I know to go and bring it. You said it's an I-O. I'm not going to bring any taxes in here. And you'll tell in a setup. So I'm just starting from the procedure first. And if you had a sales order, if you says, oh, it's an O1 or it's an O1, then I'm going to set the conditions that I'm going to pricing procedures. When it hits these conditions, it's going to access the tax codes and bring them into the pricing procedure so that you can either have a rate or it doesn't have a rate. But it's going to trigger those tax procedures to go look for those rates that we're going to set up in these areas here and say. But it's kind of driven by these kind of four indicators. You got one on the sales side, it all starts with an O, and it's 1 or 0. On the payable side, it's an I, and it's a 1 and a 0. One's taxable, one's non-taxable.
Mm.
The 1 is typically taxable, and the 0 is typically non-taxable. So O0, O1, or I-0 and an I-1. You'll see those as tax codes. Then you set little indicators on them to say whether it's so, and even when it goes out to a external application, those indicators are still being used in the system. If I were to use Vertex, I'd tell O1, I said O1, whenever O1 is used, go to Vertex. And there's a little marker inside of O1, use SAP tax procedures or use Vertex tax procedures.
US, O, USX, OJX,
Yes,
something like that.
yes, yes.
OSX, USX.
Yep. It says use an external tax procedure or use an internal tax procedure. But you set that in the tax code to say where to go find the rate. So it's saying, so it's all kind of access driven. Certain conditions are met and it brings those codes into the pricing procedure of the sales or into the pricing procedure of the person. But you only want certain materials and or customer combinations to have taxable tax codes on it. So you're telling the system master data config driven because master data and configuration drives the process. Like I said, okay, if you use this tax code and I'm putting this tax code on this customer, and this material, then those are the rules to drive these other processes. So it'll say, oh, I'm gonna bring in the tax procedure, I'm gonna go fetch the rate, and I'm gonna use that process into that process. But it mainly come and saying, hey, here's certain sales conditions, and if it's not to a retail customer, you put a tax exempt on there. If it's to a distributor, it'll be tax exempt. If you put it to a retail, it'll be taxable, that kind of thing. And so it's going to create that tax code and it's going to call you a procedure. So now you're simply saying you got some conditions, those conditions that cause a tax procedure. Some of them are these are accounts payable ones, and these are um, AR ones. It has its own codes. So on tax procedure, you'll see some is a JX01, and some will say, MW01. You'll see the MW01s used on the AR side and the JX01s used on the accounts payable side. And I'm just quoting hypothetically what these codes are. But when you look at the tax procedure to access sequence to call those tax procedures into the pricing procedure, um, there's a sum that says, okay, multiply this one by you, depending on how many levels you have. So if you have a jurisdiction SAP, you can say the jurisdiction is Illinois, IL 001. That's the next code is the state. The next two codes is the county. The next two codes is the city, and so on. So it's usually a 10-digit tax jurisdiction code, something like that. And you would divide it up when you set up define the jurisdiction. You divide the tax jurisdiction into the different 2-digit blocks. The first 2 digits is the state, the second 2 digits is the county, and you divide it up. And so it's gonna and then you define the jurisdiction codes by dividing up the tax jurisdiction into the different 5 levels, however deep it goes, 4 levels or whatever. And you can divide it up as just 3 digits, 3 digits, 3 digits, or 3 digits, 3 digits, 4 digits to equal. If you only want to go 3 digits, but if you want to go 5, you do 2, 2, 2, 2. They'll give you 5 different sections in there to call up. Then you have to define the rates for each one of those 2-digit codes. It's going to be, Illinois is going to be 5, county is going to be 2, and point at a half a point, and so on and so forth, right? So, but you see to specify the structure of the tax jurisdiction. That structure, you're splitting it up so that you can break it down by how many jurisdictions you typically have in a state. 5 deep, something to that effect. You know what I mean? And so that's where we are. That gets us a minute till 9?
Yes,
But I don't know if we didn't get to there quick enough.
Oh, you.
I hope that I defined it.
Yeah, I'm gonna go back and tear it apart.
But you can see where
there's still. I think there's more screenshots on here if you wanted to.
Yeah. So so you can see here, but then this is kind of telling you which one of these. This is like SAP. This is the one you would use for external. So it's an external application. And then you'll see it says AP. These are the ones you're using for AP. If you go down, these are the ones for AR. See here, these are AR ones, these are AP related ones. So you'll see over here, these account keys, you're going to point these to ledgers. Same concept on account keys. If you need to record it to a ledger, it's going to come over here, and then you're going to assign these account keys to an account. But this is the procedure says, okay, if you want to, this is the base amount of the sale. So if you see, go to the base amount, 120. So this is one, 200 equals 100 and 110. So if it says 210, go to 120 and get whatever rate typically it is. It points to the base to go get it. So you can see this kind of look a little off. But this is, it's like a spreadsheet says, okay, go to this and get the base and multiply that whatever you have the rate in there. Ready? Which is going to come. Okay, so you'll see it's it's percentage based. But you will see it's broke AR and AP is different. You can see this has 4 levels. See, that would be broken out by the two different. So you can see they're starting out with 4. This is defining the conditions a little bit more. This is where the tax code will come in at the country level. So these were all you'll see in the U.S. is only going to be those ones that we talked about. This is the access sequence. When the country is used and its tax code is used, call up that access sequence when those combinations are present, and then you'll see the country and the tax code. Now here, see these are using these foreign ones, but like self-assessment, AP self-assessment is when they didn't charge you. They didn't charge you. You got to self-assess. But it'll be typically you won't use this the one O2 UFC because the ones that I'm typically using it says a 10%. So you can see here, this is an AP, a use tax. You're gonna self-assess it. This is for expenses, this is for inventory, and this is for a self-assess. They didn't charge it, but they should have charged it. So I'm gonna accrue it, and I'm gonna use that. See, this is let's say California. Typically, we would have I-1, I-2, using SAP standards. This is creating this O. Yeah, this is on the sales side. So on the O, this is on the sales side. So it would be O1 or O0, and you will see these are not AP related. So you're only going to be dealing with AR down here. I don't know why. Okay, this is AP because it's self-assessed. But yeah, but you put the rate here whenever this combination, and you will have a C1 O1 000. That will be the county level, but you'll have to have one for every county. O2, CA01, CAOO, CAO3, CAO4, CO. And each county and represents in California, you have to have one for every county in California. It could be, O1, O2, CA01, 000, CO. Then you go down level, each city in that county, CA01, 001, CO02, and so on and forth. And then you give them a rate, or however level deep you go down. So this is just at the state level, and then you go the one right below will be at the county level, and so on and so forth. You see, this is telling you with the GL according to that account key. And so now you'll see those procedures are, but it's stopped at that state level. But you breaking that state down to each one of those little, however, if you charge it in four, if it was like a tax procedure, we had 4 structure, then you would have broken that CA000 into 4 different chunks so that you could have divided it up. But you got to assign the numbering schema for that 10-digit code, right?
I'm gonna ask you a question.
Yeah.
And I'm pretty sure you answered it already. But I'm gonna ask it again.
Okay.
All right. As far as tax codes, tax procedures, tax conditions, and condition access records.
Okay.
And I'm seeing how they relate to each other. Are all 4 of these components both active on the AP side and the AR side?
Yes. You're going to have a pricing procedure, Each one of them gonna have a pricing procedure. A purchase order has a pricing procedure.
Mhm.
A sales order have a pricing procedure.
Mhm.
An access sequence is what conditions trigger, like customer tax code. What triggers to get into that pricing procedure, and it brings the code into it. It brings the tax condition along with it,
Mhm.
right? And so, what's the access sequence to call that condition? Combination tax code material brings those sequences in, and it brings that rate into the pricing procedure.
Mhm. Mhm. Mhm.
When the access codes are hit, it's a combination, and then it brings it into the tax pricing procedure.
Okay.
If it's an I-0, it's non-taxable, it's going to not bring any rates into it. If it's a taxable, it's going to go out and say, okay, I found your conditions. You said this is taxable. I'm going to bring in the rate from that particular access and into the pricing procedure.
Mhm.
And I'm bringing those conditions with the rates that you told me that I need to bring in with that condition.
Okay. Okay. I think I'm tracking.
Okay. Yeah.
This is what I needed.
Okay.
You just connected all of that.
Okay.
Now I get to do my homework.
Okay. Let's get it. I know this. People are looking at us cross-eyed.
Mm-hmm. That's all right. I'll take it.
You take a cross-eyed look at.
Yeah.